Let's talk a little bit more about those markets. They're going to be getting a healthy dose of earnings this week. Plus, they'll be paying close attention to what the Fed might say about a timeline for rate cuts at its policy meeting this week. Joining us right now is Joe Amato. He is Chief Investment Officer at Neuberger Berman, which has more than $460 billion in assets under management. Joe, speak to that point.
Morning.
Energy markets have been incredibly calm. Equity markets have been incredibly calm, and yet the worries about escalation are pretty real if you talk to anybody who follows
I think the
policy.
Resilience of markets were remarkable, both last year in the face of a lot of tightening of financial conditions and this year so far. Because this weekend's events remind us the world's still a dangerous place. You've got two hot wars going on. You got a building Cold War. And at all the same time, we're trying to sort through things like earnings this week and a Fed meeting and a jobs report that come out later this week. So there's certainly lots going on. It's going to be an eventful week.
The idea of cash on the sidelines, you say that there's a record amount of that, too. And that's kind of hard to believe, given the run we've seen with the markets.
Yeah. Particularly on the individual investor side. I think there seems to be still a big chunk of cash. And our advice to clients is to start putting that to work, because you're going to see a decline in rates at some point.
So
we can debate whether it's March.
There's going to be a better entry point.
We think that you should gradually put your money in as the Fed has now shifted gears significantly. I think that's very, very important in the context of keeping cash where you could have earned or were earning 5+%, and that's going to come down at some point, right? What the timing of that is, right? Still 50-50 for a March reduction, but at some point over the course of 24, we do expect rates to come down, and that's a reason to start putting that cash to work.
We had Roger Ferguson on, the former vice chair of the Fed, in the last hour, and his expectation is that you're going to hear Jay Powell really trying to walk a tightrope, which is to acknowledge the idea that inflation has come down pretty steadily, but to hold off the market's expectations for a rate cut as early as March.
I think it's sensible for him to do that. He can't deny the data, right? If you look at the 6-month average of PCE, it's less than 2%. So if you start looking at an inflation level there and policy rates at 5.5%, you've got real rates that are quite restrictive. So it's going to be hard for him to fend it off too much, but I think he wants to maintain optionality, as I think any of us would if we were in that position.
If he's able to do that and kind of try and convince the markets, I guess that's the question. No matter what he says, will he be able to convince the markets that rate cuts aren't coming in March?
Well, I think the market's certainly going to listen to what Chair Powell has to say, but they're also going to look at the data points that are coming through. And the data is not one-sided. There's plenty of data points that are on both sides of an argument of a slowing. I mean, our own view is that we do expect the economy to slow in 24 off of a pretty robust level in 23. So, you're going to see some positive data points. You're going to see some challenging data points. And I think that allows him to balance that tight walk a bit more, right, given it's not necessarily a clear indication.
So do you think that's the big issue this week, or do you think the bigger issue is going to be the earnings front, especially with the 5 of the biggest technology names reporting this week?
Well, no one expects any movement in rates for the Fed meeting this week. I think the jobs report and earnings. So we've got a number of the mega cap technology stocks reporting this week.
Apple, Alphabet.
And as we know, they've held up the market, right?
Yeah.
The expectation fourth quarter earnings for those companies is they're going to be upwards to 50% in aggregate. The rest of the market, the other 490 whatever stocks, are down essentially 10% in the fourth quarter. So you blend it and you have flattish earnings. So the earnings of these companies are very important in keeping the market where it is.
Each of these companies has its own issues that the street's going to want to hear about. You've got Microsoft, Apple, Alphabet, Amazon, and Meta. And some of them are going to tell us a little bit more about the online advertising market, and that'll be something to be kind of behold. You've got questions about the cloud. You've got questions about AI and what kind of growth you can see from some of these companies. What are you kind of keying in on?
Well, I think there's a whole host of factors and idiosyncratic factors for each of those companies, so it's hard to make a general comment. But I think the bottom line is you want to see continued strong earnings growth in those companies. That I think is necessary for the market to continue the rally we've seen so far. And the rally, what we've seen so far this year is really a bit of reverting back to where we were pre-strong year-end rally, because you've seen the tech sector up 6%, the market's overall up about 2.5%. But you've got small cap down 2.5%. So you've got, again, once again, a very narrow performance in the market. So strong earnings by these companies, I think, is going to be critical.
So where are you telling investors to put their money right now? Are you looking at areas like small cap where they're still down? Or are you looking at some of the indexes where we're at all-time highs?
Yeah, I think across the spectrum of assets, we think the fixed income story in 24 is, frankly, a bit simpler than the equity story. I think in the equity story, you've got slowing nominal growth. Mm-hmm. So last year you had, call it 7.5% nominal growth, and you had essentially flat earnings. This year you've got probably 4 to 5 nominal growth, probably more closer to 4, and you expect 12% earnings growth. So I think earnings are a little bit more complex this year, whereas taking cash and moving up the duration curve to start capturing some of the higher rates, I think, is an important first step in putting more risk on, as we've seen the shift from the Fed jamming on the brake, keeping their foot on the brake, to now lessening up, which I think is an important segue for clients.
So the Fed really is driving all of this. It's what the Fed's doing that's going to...
Certainly, given where policy has been over the last number of years, the Fed is in the driver's seat for sure.